Welcome officially to Chapter 3. It might look like a short chapter, but you read, you took notes. There's a lot to it. And there's a lot of little intricacies that get kind of confusing. I plan on talking about timing issues, or the first section today, the basics of adjusting entries. I'm going to actually wait till after our fall break to do the heart of the chapter, because I think a 4.5-day weekend is going to be too much time spent away from it. So I want to lecture, just the intro lecture, and then you'll do some end of chapter stuff for that e-learning activity like we talked about. We won't get into the actual adjusting entries until after our fall break, because they're hard. I don't want that much time to be divided. Speaking of time, let's start talking about timing. This gal is going to just talk about adjusting entries, what they are. I'm going to show a couple more videos than I typically do, simply because there's a lot to this chapter. So I just want you to get a few different perspectives. She has a little bit of an accent, just to warn you.
Hi, Elf here, and today we're learning about adjusting entries. In the last series of videos, we learned about the difference between cash and accrual accounting. We learned why accrual accounting is used when recording transactions in the accounting system. The problem is that running a business is a process, and that process takes place over a period of time, not a point in time. That means that transactions may start in one period and not be completed until sometime in the next period.
That happens a lot. You know, to do accounting, like to stop and say, right now what's happening, there's a lot of floating things going on in accounting. If I go to the dentist today and have some work done, and they close their books and end their fiscal year, and I haven't paid them yet, there's a lapse there. And it's not like they shut the door and say, well, Jenny Mars hasn't paid her bill yet. We got to shut the door because it's just way too terrible on our accounting books. No, the business and time have to keep going. And so it gets very tricky because time doesn't stop, but sometimes their books have to as they close one year and open a next. And so it's the hardest part about conducting business is all those floating services, floating bills, money coming in, money going out. It's hard.
Since some transactions straddle a period end, we have to review our financial statements to ensure that everything has been appropriately recorded. We also have to look to see if there is anything that should have been recorded that hasn't been recorded as yet. The entries we make to adjust the financial statements are called adjusting entries. Adjusting entries exist because we have the accrual basis of accounting and because we break the life of a company into arbitrary time periods. We can do that into quarters, semi-annually, or fiscal year end. In this series of videos, we'll be answering the following 4 important questions. 1. What is the relationship between accrual accounting, time periods, and adjusting entries? 2. What are the 2 groups of adjusting entries, and what are their characteristics? 3. What are the 4 different types of adjusting entries? And finally, 4. For each type of adjusting entry, how do we calculate and record the adjusting entries at the end of every period? All right, let's get started.
So let's first talk about time, which is called the time period assumption. Accountants divide the life of a business into fake little time periods, months, quarters, or years. Quarters, of course, are 3 months at a time. So January, February, and March typically are quarter 1. April, May, June, quarter 2, in those trios of chunks. A lot of what this book does is on a monthly basis. It would be pretty crazy for an accounting department to close the books every month. Typically, it's over the course of a year because there's a big process, as she said, to close out the books and get ready to do a new accounting period. Fiscal years and calendar years can match up, Not always the case. Monthly and quarterly time periods, which of course are not a full year, are called interim periods. A publicly traded company, when their shareholders involved, have to do both quarterly and annual financial statements. So we've done income statement, owner's equity statement, balance sheet. Those are financial statements. Publicly traded companies or public companies legally have to produce them quarterly and annually. Fiscal years and calendar years can match up. They don't have to. What you need to know, a fiscal year is actually considered an accounting time period, not necessarily January to December. I mentioned our school's fiscal year starts on July 1. It's still 12 months long. It just doesn't follow the calendar. Why? What's going on in the middle of the summer here at school? Not much, unless you are in the district office. It's oftentimes the busiest time of year for those ladies because they're wrapping up one, notice I'm not going to say calendar year, I'm saying a fiscal year. They're busy people to begin with when we're all here. Imagine trying to do that when all the busy people are here. Crazy. Other businesses that are seasonal. I'm not saying it's true every time because some people are like, it just makes more sense for me to have my books from January to December. Like, it's just, it seems more logical. But think about how busy, say, like a snow removal business potentially could be in December. Then this, like, oh, I can't go plow snow today because I'm trying to wrap up my year-end books. So I'm not saying it always doesn't match. It's just, it depends on the industry you're in, okay? A lot of businesses do match the two, however. Here we go with these terms. Accrual and cash basis accounting. Let's start with accrual basis accounting. Transactions, we know that heavily from last chapter. Transactions are, remember, in the general journal and then posted to the ledger. Owner invests $10,000 in the business. We paid cash for supplies. Purchased equipment on account. Those are all transactions where there's at least one debit and at least one credit. And then from all of that work, we create what's called the trial balance. The question is this: when we buy supplies, let's say on January 1, and we are running our fiscal year based on our calendar year, on December 31st, are we going to have all those supplies still? No, what have we probably done with those supplies? Used them. What if we haven't used all of them? Should we throw the extras away? No, we'd roll those into our next fiscal period. Under accrual basis accounting, we are going to recognize that we bought the supplies, that we paid for the supplies during the year it happens. Let's say we instead buy equipment on account. And let's say we decide we're going to buy that equipment on December 30th. We don't pay our bill till January, and we're ending our fiscal year at the same time as the calendar year. We're still going to say we bought that equipment now. We're not going to act like, ooh, we're not going to look in our books. We're not going to make it look like we bought it when we paid for it. We're going to say we bought that equipment when it happened. What you need to know about accrual basis accounting is we are recording all of it as it happens. Whether the cash is there or not. So cash is kind of a question mark. In a minute, we're going to talk about cash basis accounting, and then yeah, cash is king. So whether, and this applies more to say ARs and APs. If we cut someone's hair on the last day of our fiscal year, and they say, hey, I'm off to my New Year's Eve party, I'll send me a bill, I'll pay you next week. Under accrual basis accounting, we're going to say that we cut that person's hair on December 31st. We're not going to wait until they pay us a week later, which happens to be our next fiscal period. Accrual basis accounting, you record stuff when they happen, whether the cash is there or not. Expenses, kind of the same thing. Expenses are recognized when they incur, another word for that is happen, rather than when they're paid. So if the light bill, if the lights are on in December, the heat's on in December, and our utility company doesn't send us our bill until January when we've turned over our fiscal and our calendar year, we still are going to say we had the light bill and the heat on in December. We're not going to wait till we pay them. We're going to say it happened when it happened. Cash basis accounting, unlike accrual basis, we're waiting till we receive cash, we're waiting until we paid cash. So my haircut example, if we go get a haircut and say, I'll pay you next week, who cares if it's a fiscal year, calendar year change? In that instance, we'd wait to record that we got a haircut the next year. Or on the flip side, oh yeah, we had our utilities running all of the month of December, but we didn't pay our bill till January. Under cash basis accounting, we'd wait to say that happened when the cash was exchanged. What you need to know about cash basis accounting, it happens often. A lot of businesses run their business this way. It's just not GAAP approved. The generally accepted accounting principles prefers accrual basis accounting. Why? It's more transparent. I mean, if I'm cutting hair and I had a haircut happen in December of 2018, if I wait until my customer pays me, then it's not going to look like I cut the hair until January of 2019. I'm not saying cash basis is wrong. It's just, I think, less accurate. Did that person cut hair in January of 2019? No, that's when they got the money. I want to take some time and just side by side compare all of this with you. Yes. You could do a mixture. It probably gets a little messy. And you know, this isn't necessarily messy, and for some industries it works. What you need to know is cash basis accounting is not GAAP approved. But you could do a mixture. You can do whatever you want. You're your business. It's just got to make sense, and you got to be ethical and not fraudulent. This should be in your notes, this little form, the notes that I gave you. What is accrual basis accounting? We are recording transactions, which now we know what those are, when they happen, whether cash is there or not. Whoa, sorry about that. Got the haircut? Great. Whether cash is there or not, it happened in January of December of 2018. It happened, we record it. Another word for happen is incur. It happens. We incur that revenue or we incur that expense. When, let's write it down again, as it incurs or happens. The transaction takes place under accrual basis accounting when the event happens, whether it's revenue or money in or expenses, which of course is money out. We say they happen when they happen, whether the cash is at the table or not. The first pro is that this is GAAP approved. It's more transparent. The events align with when they happen. The events align, like, I know it seems so obvious, but when it happens, we record it. What are some cons to this? What are some of your guesses? Yes. Cash becomes a little bit of a wild card. Okay, someone pays, well, what's this? Oh yeah, that was from last year, and now they're paying us this year. But remember what that lady from the video said. Time doesn't stop. It just kind of is a lapse from when it happened to when we get paid. So cash becomes a wild card, kind of as Riley was describing. Let's talk about, just write bad ARs. What happens if they default and don't pay you? Then all of a sudden we got to go back to last year and say, oh gosh, we gave them that haircut, but they didn't pay us. My example, we'll put down my haircut thing. So if the fiscal and the calendar year is the same, so on December 31st, on the way to the New Year's Eve party, someone stops and gets a quick haircut. We need to record that on December 31st of 2018, that revenue came in. And they said, oh, I gotta go, I'll pay you next week. Well, next week will be a new fiscal year. So under accrual basis accounting, we're like, fine, we'll count that revenue for 2018. We're not gonna actually get paid till later. And later meaning another fiscal year. Let's take this same story. Let's take the same story down here. Under cash basis accounting, it's like that haircut never happened. Rather, let's say on January 4th, and oh, how was your New Year's Eve? Great. How was mine? Great. By the way, here's my money for my haircut. Let's say on January 4th, they show up to pay. Under cash basis accounting, those books are not going to look like that person had a haircut until January 4th, because we're not going to record anything until they pay us. Haircut happened last year, which happened to be just 4 days ago. Now they come and pay. It's like the haircut happened on January 4th of 2019. Doesn't that seem kind of shady? Like to wait? You might say no, because it's cleaner for cash. Like I'm getting my cash, but it's the concept of when it gets recorded from a transaction perspective. The revenue was earned in 2018, not 4 days later when they pay us. So what is cash basis accounting? We are only, I'll switch pen colors here. We are only recognizing transactions when the cash is present. Sorry, I missed the word recognize there. We're only recognizing transactions when the cash follows. When, it's whenever the cash is present. In this case of our haircut, the person came back on the 4th of January and paid. So under cash basis accounting, it's like the haircut didn't even happen until they paid. The pro, hello, the cash is there. It's not this wild card floating cash, are we ever going to get paid? The big con is GAAP doesn't like this, and revenue isn't necessarily accurate. We earned that haircut revenue on New Year's Eve the year prior. 4 days later, yeah, the cash came. Did this help to just kind of side by side put it all together? Good. This is what the Google form is going to be asking you for on your e-learning practice day. Let's watch another video, and this one's terribly illustrated and even like worse voiceover. So just bear with it. It's got a good message though. Happen, occur, incur.
What happens when you don't have cash? Well, my buddy went to the store and talked to the manager. That he broke his board, wants a new one, but has no cash. He works for KPMG and is good for it. The manager said, okay, my buddy took the board, and the manager includes the revenue. You can do that? Yes. The manager expects my friend to pay that, and the manager earns that revenue as soon as the surfboard left the store.
Does that make sense? Is this accrual or a cash basis accounting? It's accrual because this person sold the surfboard left the store, even though that the buddy who broke the surfboard didn't pay for it. That surfboard company made, the revenue occurred in that time period.
Quite a bit. My clients always pay me before I do any work for them. That must be pretty sweet. It's sweet, but it still increases my unearned revenue account, and I still have to do the work in order to actually earn the money that they gave me. You need help with anything else? Debits and credits. Okay, pay attention, because if you don't know this for the file, you are going to be UCAD. Correct. What do you mean, Deb? You need debit, expenses, assets, and dividends. Everything else is a credit or asset. Debits increase the account, while for liability and owner's equity. Debits decrease the account. Remember debits on the left and credits on the right. Debits on the left and credits on the right. So, let me get this straight. If my cash account increases, I would debit the account. Right you are. It's Ryan. Whatever. Thanks for your help, Kathy. If you get stuck again, stop. Don't wait this long to do help. Come to my office hours. It's Ryan. See you in class, Kathleen.
Terrible in so many ways, but from a content perspective, it's so good. So good. We are unfortunately not done. And lucky for us, we're not out of time. So there's all of these different principles and assumptions and basically little rules. The revenue recognition principle, which you should probably have in your notes, recognizes revenue in the accounting period in which the performance obligation is satisfied. So when we earned the revenue, whether the payment was there or not, this is very much under the accrual basis accounting umbrella. The revenue recognition principle recognizes when we earn the money, when we did our work, whether the money was there or not. The expense recognition principle matches expenses with revenues in the period when the expense makes its contribution to revenue. Allow me to explain further. This Friday and Saturday, I am having my 5th annual Junk by Jenny sale. As part of the sale, I provide hot cider to all of my guests. That is an expense. I need to match that expense with whatever it went with. So I'm going to earn revenue, hopefully, this weekend, and any expenses tied to that revenue better match up in the same period. For me, it will be, I do monthly books the month of October. Does that make sense? Any revenue that is offset by expense, those expenses better be attached to that revenue when it happens. That's what the expense recognition principle is. See how you do on this. One of the following statements is about accrual basis accounting. Let me say it again. One of the following statements about the accrual basis accounting is false. Which one is it? Which one is false in regard to accrual basis accounting? So in other words, recording it when it happens, no matter if the cash is there or not. Great if it is. Which one's false? D, it is. Why? Revenue is recorded only when the cash is received, and expenses are only recorded when the cash is paid. That's called cash basis accounting. We'll come back to this one. This will be part of a Google form available to you on Wednesday when you practice an e-learning day. If this is where time ended and all of a sudden a snowstorm hits, could you answer those questions without a book, do you think, at home, if you had to do it at home? You probably could do okay. Speaking of it, since we've got just a smidge of time, how would you answer accrual basis accounting? A, B, C, D, E, or F? Very good. Number 2 is what? E. Can a calendar year and a fiscal year match? Yes. Time period assumption is what? C. Months and quarters are technically artificial time periods in the accounting world, that is. Expense recognition principle. My hot cider example. In order to earn revenue, now is my hot cider going to be the only way I get people there? No, but that expense, some of you are like, yeah, it is. That expense needs to match its revenue earners. So tomorrow, I am not going to cover all of this. I'm really only going to cover the first bulleted point. After the fall break, we will get into the other bulleted points. Just know that it's not necessarily bad to use cash basis accounting. It's just not as transparent. That's all I have, folks. Have a great day. Enjoy the sunshine.